Hey everyone, welcome back to another weekly market outlook. This is for the last week of the month of March, which is the 27th to the 31st of March 2023. So let's take a look at a little bit of a recap on last week. So I do have a few notes here. So we have the FOMC raising interest rate by 25 basis points. This is in line with market expectations, citing the need to maintain a balance between economic growth and inflationary pressures. In response to the recent banking crisis, FOMC has highlighted the robustness of the financial system, which has helped to mitigate the impact of the crisis on the broader economy. The latest dot plot, which reflects the FOMC's interest rate projection, indicates a lower than expected projection of 5.25%. Market was expecting a 5.5%, signaling a more cautious approach to future rate hikes. Based on the current interest rate level of 5%, the FOMC is projected to hike rates by another 25 basis points, potentially in May, before potentially pausing to assess the impact of previous rate hikes. Median interest rate projections suggest a potential for rate cuts in 2023, possibly as early as the first quarter of 2024. This reflects the FOMC's ongoing commitment to maintaining price stability and supporting economic growth in the face of ongoing uncertainty and volatility in the global markets. Now, we also have the headline inflation in the UK that's jumping up a little bit. If we take a look at this here, it went up to 10.4% from 10.1%. This is missing the consensus for a drop below 10%, which is anticipated to come in at 9.9%. Swiss National Bank also hikes rates by 50 basis points from 1% to 1.5%. We also have the Bank of England hiking interest rate by 25 basis points from 4% to 4.25%. Votes for that remains the same. We've got 7 votes for a hike, 2 for unchanged. And basically, yeah, there's not really much of any forward guidance coming out from the Bank of England, although there were actually no mention of possible rate hike pause in the statement. So we might actually see the Bank of England continuing to hike rates going forward in the future, considering the higher inflation number. One thing to note here, which is a little bit weird, Governor Bailey does keep on mentioning the expectation for the market to expect a quick drop in inflation this year for the UK. So I think that's something to take a note for. Also, we have a little bit of a run to safe haven assets going through. We've got a drop in Deutsche Bank's shares. Basically, in the month of March, it lost about 20% of its value just in the month of March. And in last week, we have a single drop of 15% basically on Friday for Deutsche Bank stocks. It does recover a little bit. The lowest drop was 15%, but it closes the market at about negative 8.6%. So it does bring in a little bit of a concern for a run towards safe haven assets. So we need to consider that. That gave the US dollar a little bit of a boost as well. Japanese yen is also considered to be a safe haven asset, and obviously gold. We also have the manufacturing PMI numbers, the flash manufacturing PMI numbers from the US. This one here, I think this is what's giving out the boost on the US dollar, because we see the manufacturing numbers jumping up really high. We've got the 47.3 expectation was a drop to 47. We instead got 49.3, which is only 0.7 away from 50 on the index. 50 means growth is going to be there. So we are basically returning towards a potential growth on the manufacturing side from the US. Flash services PMI also improved significantly, jumping up from 50.3% to 53.8. Okay, so for this week, we do have a little bit of a quiet week. On Tuesday, we've got comments coming out from Bank of England, Bank of Japan, ECB. We also have several Fed members scheduled to speak on Tuesday. So I think Tuesday, It's likely going to be more driven by what the central banks are going to be doing, considering what's going on with the whole banking industry right now at this point in time. On Wednesday we've got the Australian CPI numbers. Year-on-year CPI expected to drop from 7.4% to 7.2%. Preliminary German CPI numbers also expected to drop from 0.8 to 0.7% on month-on-month basis. Final GDP numbers from the US. Quarterly numbers, obviously we are going to be looking at that. It's going to be expected to remain stable at 2.7% growth, which is, I think, it's still a great number. Also, a little bit more jam-packed on Friday. Friday we are actually going to be focusing a little bit more on the flash CPI from the Eurozone, expected to drop from 8.5% to 7.1%, which is a huge drop. That's a huge drop in the consensus. So from 8.5%, expecting the numbers to come in at 7.1% for the flash CPI numbers in the Eurozone. Core CPI, this one here is in line with what ECB is expecting a little bit of a nudge higher from 5.6 to 5.7%. Also, we have the US PCE index. Month to month, we are expecting a little bit of a drop from 0.6% to 0.4% from the US. All right, that's pretty much it from fundamental side of things. Pretty quiet week this week. So let's focus on the technicals. So if we take a look at the dollar index here, we do have a strong support coming in at 102. Now, if you take a look at the momentum, this is where it's a little bit interesting, because if you take a look at the stochastics here, the stochastics is actually about to come off the 20 level. So this could actually be an indication that the dollar itself could actually be oversold. Now, the current condition, it's obviously this is below the Ichimoku cloud. So we want to see the index pushes up higher. Ideally closing above 103.50, at least on the daily time frame. That will also take this up a little bit on this momentum. It will confirm the oversold condition. So we definitely want to see a move higher above 103.50 before we can say, okay, this is time for the US dollar to have a little bit of a bounce back up. Right now, it is pretty strong. The support 102, we see that quick reversal that's going on the dollar index here. We do notice there's a morning star, and everything kind of matches up. We've got key levels 102, so we're just waiting for that level to be broken, 103.50 to be broken, and once that happens, then we are likely going to see a stronger US dollar. Now, this makes things a lot simpler, because if you take a look at the yields has also improved as well. 10-year yield, this is now back up above 3.5%. Now, do note the treasury market is having a little bit of a problem with all the banking crisis, and the recent credit default swap that's been going on with Deutsche Bank, which is basically what's dragging Deutsche Bank down. Just a quick one, CDS is basically an insurance for bonds, and that's basically it. If it goes up, obviously the cost is going to go up as well, and if it is a little bit more of a risk, the CDS value is also going to go up. So right now the yield, we are looking at a little bit of a recovery on the yield here. Obviously we saw that this is an inverse relation with the bond prices, so we do see bond prices coming off from the US. We do see the 10-year yield picking back up above 3.5%. All right, now taking a look at the Aussie USD, this one here is in a very interesting situation, because it kind of forms a bearish flag pattern on the Aussie USD. We've got 67 as a key resistance. Now, at time of recording, price is actually coming back up close to 67. So we actually do have a notable key resistance at 67.50. This is where the Kijun Sen is also located. The ideal scenario is that we want to see a break below the current channel that we have that's forming the bearish flag at this point in time. So what we want to see is actually a close below 66.50. That would actually trigger more of a deeper sell, much more pressure that could actually drive this towards 65 cents. However, because this is very close to resistance at 67 and 67.50, so and in the range between 67 and 67.50, some traders might actually want to go in there as a potential short to get in a little bit earlier, but with a smaller risk as well. So the option is there: either wait for a break below 66.50 or attempt to go short closer to 67.50. Having your stop losses not really too far away from 67.50 is also not a bad strategy, because it kind of minimizes a lot of the risks on this potential trade. But for the Aussie USD, the overall outcome for this one here is that we are still looking for more of a downtrend continuation for the Aussie USD, right? With the Euro USD, this one here, we do have that resistance 1.0850, 1.09. That's basically capping the market at this point in time. In terms of whether or not this one can move lower, the euro is actually in a very unique situation because we have a hawkish ECB, we have a slightly dovish FOMC, so it kind of supports the euro a little bit. So the euro, this one here, getting pressured lower, it's getting a little bit tough for the euro. So technically speaking, we are actually between in range between 1.0750 and 1.0850. Ultimately, we do have that 1.09 as a resistance. If we do break above 1.09, then it opens up opportunity towards 1.11 on the Euro USD. However, if there's that close below 1.0750, then we much prefer to go in for a short on the Euro USD, having a stop loss just slightly above 1.0850 or 1.09. So this one here is still up in the air, but if we take a look at the momentum does crosses down. However, there's no strong indication that it's in that overbought territory at this point in time. The pound USD, this one here is a little bit unique because it was trapped between 1.22 and 1.23. Right now, at time of recording this morning, price on Tuesday, the price has actually moved up above 1.23. There is no confirmation yet whether or not there's a daily close above 1.23, so we could actually see price move back down below 1.23. If it does so today, then it will actually be still range bound between 1.23 and 1.22. Now there are two options, obviously, with the pound USD. If it does confirm a daily close above 1.23, then we're likely going to see the pound USD track a little bit higher towards 1.24, 1.2450. However, if it does break below 1.22, we've got one more support at 1.2150, and below 1.2150 we've got nothing until about 1.2. Now, considering the current condition and the expectation that there might actually be a bounce on the US dollar, we do anticipate that 1.23 level to be a strong resistance for the pound USD, but it really depends on how it closes on Tuesday, whether or not they'll actually close above 1.23 or if price managed to get pressured back down inside that range 1.22 and 1.23 again. All right. Next up, it's the dollar Japanese yen. Now, the dollar Japanese yen here, this one here is a little bit easier. We do see price pulling back really sharply on Tuesday. This opens up a good opportunity for a buy with a stop loss below 130. Now, if we take a look at the reason why we look at that 130 level, 130 is a very significant key psychological price level. 130 is also the previous support level on the dollar Japanese yen. Now, with the dollar Japanese yen, if we take a look at the bounce, the turnaround from 130, it does form a morning star as well. So I think price moving close to 130 right now. This is about 130.50 at time of recording, and if we attempt to go long on the dollar Japanese yen, your stop losses is actually going to be a little bit smaller. Now, because we anticipate that bounce happening on the dollar index, we do anticipate that bounce happening with the dollar Japanese yen as well. So the dollar Japanese yen, in terms from a technical standpoint, I think it provides a good opportunity for a long position, very close to support. And also, fundamentally speaking, if we are considering what's going on in the market, there's that possible run towards safe haven, that could actually drive the US dollar a little bit higher as well. Now, the only issues that I have here with the dollar Japanese yen is that if there is that run towards that safe haven, the dollar is going to get stronger, the Japanese yen is going to get stronger. The dollar Japanese yen might actually go flat because both the dollar and the Japanese yen are basically moving in the same direction. But considering the gap that we have, or the timeline that we have between 20th of March to the 31st of March, this is where the Ishimoku cloud is rather thin at 132.50. If price manages to go back up and closes above 132.50, then it actually opens up further projections to the upside, 133.50, 134.50, and potentially even higher. So from a risk to reward perspective, getting in close to 130 support provides you with a minimal risk in the market for a much how do I say it? larger gain in terms of the potential reward. So I think from a risk to reward perspective, I think where the current price level is very close to key support at 130, and jumping in for a long around this key support level could provide you with a minimum risk into the market for that potential long trade on the dollar Japanese yen. All right. Next up is Bitcoin. Bitcoin here, there's a lot of issues going on with Bitcoin. Binance just basically have, they basically just got technically sued by the regulators in the US. So it does take off a little bit of the shine from Bitcoin. That would be how to put it. We've got a few key levels. One is actually 27,000. If price is able to maintain a position below 27,000, and looking at the current change in the current shift in momentum, we might actually be potentially looking at a move lower towards 25,000. Now, if we take a look at the fibs that we have here, the whole run in the month of March, that basically went all the way up to 161.8%. So in terms of how far up it has gone in one cycle, I think we have already hit the limit there. So any move or any confirmed close below 27,000, that's likely going to take this for a little bit of a retracement, a little bit of a pullback back towards 25,000 for Bitcoin. All right, last thing, it's gold. Gold here, if we take a look at the key level last week, we did talk about 2000 and 1950. So that's basically what happened from the previous outlook up until now, that we see price traded between 1950 to 2000. And so far, it is still within that range. Now, we are keeping a very close eye on 1950, because any close below 1950, if we take a look at this one here, it might actually take gold a little bit lower, potentially towards 1900 for gold. And for that to happen, it could actually be just between 1 day or 2 days. So any close below 1950 could take this lower towards 1900. Ultimately though, the key levels that we are eyeing for is where the Ichimoku cloud is located, and that's actually located below the support level, the support range between 1880 to 1900. That's located a little bit lower at about 1860. So for gold, yeah, the cap is going to be at 2000. That's going to be a very strong cap for gold, even with the whole run to safe haven. If it does happen, it's still going to be really tough to break 2000. So it is actually easier for the market to actually break 1950. It's actually easier for us to see a potential retracement going on in gold at this point in time. Now, do note that gold, with the run throughout the whole month of March, has reached 127.2%. So we might actually consider a possible end towards that extension. All right, with that, that's the outlook for this week. Good luck for the trades, and I'll see you soon.